And today's big story was China might stop buying our Treasury bonds again, right?
Right.
And you know what I really think? I mean,
they want to get it. They want to get them cheaper.
Well, this kind of talk only sells financial Armageddon newsletters. Yeah. And it just makes no sense because first, from a game theory point of view, if you're the China government and word gets out you're selling bonds, the market would go to zero. There would be nobody buying because they know how many bonds the Chinese have. They'd only hurt themselves. And second, on a fundamental level, people forget that bond prices are directly linked to stock prices because a fall in bond prices will send up yields. So let's do a little thinking exercise, right? If bonds went from 100 to 0, rates would go from 3 to infinity. Well, interest rates at infinity couldn't possibly be any good for stocks. So if you believe that bonds are worthless, then stocks are worthless too. It's time to get that guns, water, and canned food and head for the bunker. Yeah. You shouldn't be in the market whatsoever. So the aversion to bonds cost investors dearly last year, but they just don't know it.
You know, at the ETF Digest, we have 10 sacred cows, and one of the sacred cows, and I can't remember which one it is offhand, says its mantra to respect the successful methods of others, which we do, which is why we're having this phone call. Because I think it takes more than one approach, particularly for individuals nowadays, to get different perspective on things and different methodologies and see how they might work together well. You have a lot of different input, or credible different input that at least complements one another, and so you have different views to choose from.
Right.
As a matter of fact, like we have subscribers that use your systems, and somehow it all works out for them, and they're very happy that way. And most newsletters are just good tools for people to use and to help them construct and deal with their portfolios, because you and I don't know these individuals and what their circumstances are and so forth. Now, in the book I wrote, Create Your Own ETF Hedge Fund, that dealt in a similar way with what you've been talking about. In other words, asset allocation being the key, and also talking about indexing and how indexing was much superior to active management in terms of all the studies that have been done in that regard. Nevertheless...
Yeah, I think the facts pretty well lay it all out on the line there.
So what's happened, of course, is that to a lot of people have walked into their friendly broker or a financial advisor or whoever it is at XYZ fund brokerage firm, one of the big wirehouses or something like that, and they just kept loading up the wagon with all these different mutual funds and have been decimated by them and have paid a lot of fees.
And what are they loading them up with now? Corporate bonds. Every day we see on TV, buy those. Well, yes, the corporate finance department is working overtime to churn out all these bonds. That's the only money that's being made right now. And so if you're a broker, well, when you show up at the office, I don't know if you've been a broker before.
I was a broker for a long time. I had my own broker.
Well, you didn't start with your own firm, right? You worked for a big one?
No, I worked for Payne Weber. I worked for Shearson, and then I had my own firm and so forth.
Well, then when you show up in the morning at one of those big firms, there's a piece of paper on your desk that says this is the product that must be moved today.
Yeah, that's why they call them wirehouses, because it's all going out on the wire.
That's right.
And then they have all these products, of course, that are, it isn't just one thing that needs to be sold today. It's dozens and dozens of things that they have for you. Just overwhelming amount of choices. And most of them suck. So, yeah.
So we've been there, done it, and we know the tricks. Don't fall for it.
We're lucky for ourselves to have made money for people last year. Now, how are you doing for your clients in, say, your portfolio and then your satellite, and then, if you can say?
Well, they've all been out since September, so everyone is happy, although I'm sure some of them are like, when do we get back in?
Yeah, that's the thing we're going through, because we're 90% in cash, have been that way for months now, and did make money last year, but that was because we were short of a brief period anyway, but now things are so oversold that we're just not interested in taking a gamble on being long.
Right.
What is your outlook?
Well, I think we can probably pretty much take the mold from what happened in Japan. I think the number one investment bugaboo out there right now is the fear of inflation. Because, everybody says, the governments are printing money via quantitative easing. And therefore, inflation is sure to come. I mean, all you need to do is see James Grant or Jim Rogers or anybody. Everybody says inflation's sure to come, except, the problem here, I think, is this. If you look at the amount of private debt that is owed by individuals in most of the industrialized countries. And then you look at the government debts that are being piled up now. What's going to happen is, well, it's going to be the return of the bond vigilantes, right? I mean, obviously the Chinese are out there now saying, oh, you better watch out. We want you to make sure that you preserve the value of the bonds. Well, I don't think that there is that much room for rampant inflation because, like, for now, quantitative easing and so-called money printing is probably all right, seeing that I'm pretty sure the real numbers are quite negative and there's deflation going on. And people don't recognize that it's pretty easy to kill inflation. You just ratchet the rates up until the whole thing blows up and that's that, right? Start again. But nobody's ever developed a good way of fighting debt deflation because there is no way to fight this thing. I think what's happening is that if you have a little spark where the economy maybe does a little bit better, you're going to see, well, the Fed will have to then take it back, right? Which is called sterilizing. And now I know that nobody believes they're going to do it, okay? Everybody believes they'll do the printing part, but they're not going to do the sterilizing part. But I personally think that they're going to have to do a certain amount of the sterilizing because if they're unable to sell their debt in the future or can only sell it at higher interest rates, well, then the borrowing costs for the government and for the individuals are going to go higher. And so if your debt service goes higher, well, that's going to dampen the economy again. So it's going to be slow death by 1,000 cuts, that every time things get better, rates rise, and it jams it back into a recession again, which is what's been happening in Japan.
Right.
So I don't really think it's going to be so easy for inflation to come back. I think we're going to be fighting deflation for some time.
Right. So that makes my short bond position not a very profitable thing to be undertaking.
Well, no, I mean, there's going to be swings, right?
Yeah.
And there could be large swings. But I think, like, if you look back and you talk to some of your quant friends, back in the day, the JGBs, the Japanese government bonds, that was going to be the trade of the century. So they thought, right, after they first started to battle their deflation. But many people were short for ages, and they never went down.
Yeah, I agree.
And if you look at the Japanese debt numbers, the debt to GDP ratio is actually much higher, and the world didn't blow up, or their world didn't blow up quite yet. So I think it's going to be, we've got a whole bunch of things. You got the demographics where everybody's getting older. They feel like they've lost a lot of what they worked hard for, and the people are going to start saving.
A more conservative approach.
Yeah, and of course, if the bank situation doesn't improve, and you see a few life insurers collapse, I think a lot of people are really going to be ugly. But I am worried about the life insurance industry because, ever since I was in my 20s, I remember my life insurance guy saying to me, oh, you should buy this universal life, you should buy this whatever life. And I said, forget it. I'm going to manage my own money. I only need to buy term from you. And now I feel quite happy about that decision and quite fortunate that I've managed my money all this way.
Well, guess what? My term is up.
Okay.
It's about to be up. So, and my provider is AIG. So
okay.
There's so many other things we could talk about, and we should probably do it another time. But thanks for being with me, and we'll talk to you again another time. Teresa Lo of www.InvivoAnalytics.com. Thanks for being here.
You're welcome, Dave. Thank you very much for your time on a Friday afternoon.